Stocks extend their Friday rebound as traders increase bets of a red Fed rate cut by the Fed next month. Secretary of State Marco Rubio says talks with Keefe for a U.S.-backed peace plan with Russia could extend beyond Trump's deadline of Thursday. A potential breakthrough is pulling oil and European gas lower, with Ukrainian dollar bonds rallying. Plus, BHP backs off. The world's largest miner ditches another attempt at taking over Anglo American, ending efforts to thwart a planned tie-up between its smaller rival and Canada's tech resources. And a look at how some of these key cross-asset indices are trading. Take a look at the S&P futures. They are up 0.7%, some green on the screen, perhaps in anticipation of a Fed pivot, with some dovish commentary coming through from John Williams on Friday, suggesting a rate cut is still on the table for December. Brent pushing lower, $62.20 is where we're at, 0.6% lower, keeping a close eye on a potential breakthrough between Russia and Ukraine. Gold also hanging in around the 4,064 levels, so a bit of an anchor around $4,000. We're going to be talking more about gold on the show. And then the pound heading into a pivotal week for the UK budget, just shy of 131. This is a picture for broader Europe. Most of these markets are trading in the green, with exception of some of the peripheries, including Italy. But as we speak about Europe, we have just got some breaking numbers coming through from Germany. Let me bring you the key figures from IFO. IFO Business Confidence Index has come in at 88.1. That is a miss versus estimates of 88.5. As to the current assessment index, it's come in at 85.6, slightly above estimates of 85.5. As for the expectations index, it is a miss, 90.6 versus estimates of 91.6. So it's worth noting that the business confidence number has come in lower than expectations and also lower than the prior months. And the other figures have also disappointed relative to estimates. This is a picture of where the euro is trading slightly firmer versus the USD. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Joanna Bersecci in Dubai. One of our top stories today, U.S. Secretary of State says President Trump's Thursday deadline to secure Ukraine's support for a U.S. peace plan could drift into the following week. Despite a note of caution following talks between the U.S. and Ukraine in Geneva, Marco Rubio says good progress is being made.
It is in my personal view that we've had probably the most productive and meaningful meeting so far in this entire process since we've been involved in from the beginning. We have a very good work product that was already built on a foundation of input from all the relative parties involved here, and we were able to go through some of those items now point by point, and I think we've made good progress.
Bloomberg's managing editor for European economy and government, Ben Sills, joins me now. Ben, well, we just heard from Secretary of State Marco Rubio there suggesting that the talks had actually been constructive, although we know that there is significant pushback coming through from Europe and from Ukraine. Do we have more details?
Yeah, that's right. I think the Europeans and the Ukrainians are trying quite hard, really, to tap the brakes a little bit on this plan, which was really conceived with a lot of input from the Russian side. And there was a lot of alarm in Kyiv and in European capitals late last week when it seemed like the US was keen to try and ram that plan through, perhaps as soon as before Thanksgiving. That timeline seems to have shifted now quite clearly, and also the Ukrainians are now engaging directly with the US and have pulled together a revised version of that plan.
I mean, there is considerable pressure coming through on Ukraine from the United States. Are they actually likely to reach an agreement anytime soon because of the amount of diplomatic pressure that Zelensky is under at this point?
Never say never. I think that it's difficult to make firm, predictions about what Trump might manage. You saw with the Gaza deal and with a number of his trade deals that he does push through deals on a time frame that really nobody else would conceive of doing things. Having said that, there's still a way apart, the Russians and the Ukrainians on any sort of peace deal here, and I think that certainly the Russian plan that we were looking at last week has got a number of conditions that would be extremely difficult for the Ukrainians to sign up to, at the same time, the Ukrainian version of that plan is going to be difficult for Putin. So my best guess would be that this is going to run for a long time, but you can never kind of rule out the fact that Trump might be able to twist arms and force things through.
Yeah, most definitely. Ben Sills, Bloomberg's managing editor for European economy and government. Thank you so much. Well, global stocks gaining after a volatile week as optimism rises about potential Fed rate cuts. Joining us now is Ursula Marchioni, EMEA Head of Investment Portfolio Solutions at BlackRock. Good to have you with us on the show. I want to zoom in more and talk more about the European equity trade, because there was a lot of optimism, some momentum around investor appetite to own European equities in the first half of the year. It feels as though since then things have started to stall. Why do you think momentum has slowed down in the last couple of months?
So good morning. First of all, Joanna, thanks for having me. I think the question on Europe is one that is particularly important for our clients domiciled in the region and therefore having large home biases in portfolios. I would slightly characterize it slightly differently, though. I still believe there's a significant desire from investors to diversify their equity sleeves and their risk allocations away from, trades that might have become very concentrated in their portfolios. So to your point, we've seen a great story globally unfolding this year of repatriation, European clients going back into European equities, similar behavior in Asia. And I believe this has still legs to grow and continue. To your point, Europe has structural challenges, which we won't deny, but the momentum around structural shifts and desire to change policy approaches is real, Jumana, and I believe it will carry through 2026.
So one of the darling trades of this year has been defense stocks, and you just have to look at the performance of some of these stocks to reflect some of the optimism in that space. I do wonder, though, given the news over the past 24 hours, if there is a breakthrough between Russia and Ukraine, what does that do to the upside, the outlook in that space?
Yeah, that's a great question. It is, though, I believe, a structural shift that we have seen happening and that will continue to play out. So defence is one of the areas that we continue to like in Europe. Taking a step back, the European trade this year hasn't been one where the tide has lifted all boats. It's been very much concentrated. And so as we think about 2026, we need to continue to focus on companies with strong fundamentals. And in terms of sectors, defence and banks continue to be, in our opinion, an interesting space to watch. To your point, defence is now quite expensive, yet if you think about the new stance taken from Germany starting to filter through and impact earnings, those valuations can see support. Similarly, the NATO 3.5 GDP target for 2035 is very ambitious, but again, even if we were to hit a 3%, you would see deployment coming. So despite the levels that we're starting at, there's still, from a structural perspective, an opportunity. And then, Jumana, I think
it's interesting.
Is also the other area.
Yeah, I was going to actually pick you up on banks. I wanted to drill down into that because those are the two areas that I think have done the best in European markets this year. And if you look at the relative valuations, this is per your latest report, you have the defense segment of the market trading at 32 times forward 12-month multiple. Compare that to around 10 for banks. Would you say that there's still a value opportunity in banks that doesn't exist in defense stocks here?
So it's a very different starting point. I completely agree with you. And the story for banks, again, is one where, we might see opportunities. There's a lot of M&A discussion, so further boost to profitability at the back of efficiencies that can be gained. But also what I would point is, to your point, an entry point that is interesting to the stats that you quoted, and the fact that the EMEA wealth market is one very much dominated and intermediated by banks. And so as we look at the region and the big wave of savers moving into investments. We talk about 14 trillion waiting to be deployed. Banks are at the very center of that, unlike in the US, where, for example, the advisory space is way more developed. And so, again, we see an opportunity there for banks to be part of that revolution and benefit from it.
Yeah, and yet banks tend to be quite cyclical. The most recent macro signals coming through from the European economy haven't been that supportive. I mean, even just this morning, we had the IFO numbers come through, a miss versus expectations. The ECB themselves aren't forecasting growth north of 1% for next year. Can banks actually outperform in that environment?
I think it's a great question. And it, again, depends on the investment horizon that people will want to see playing out in their portfolios. And again, is it a 3, a 6, a 12-month trade? What I believe is happening in markets, and there's been a lot of discussions last week in your opening just now around what is happening around the AI trade. What I observe is that investors continue to want to hold risk, but are certainly reducing incremental position as we approach year-end. They're taking profits, particularly in certain areas. And so, for example, for AI in the US, we have seen through exchange-traded products some buying last week, so buying on deep, but again, tempered by desire to diversify the risky exposure in the portfolio with also an additional allocation to, for example, US healthcare to build some defensiveness. And I think, Chumana, banks and Europe as a whole, and can be positioned in this broader picture where investors want to take profit in the big trades that have played out in their portfolios as we approach year-end rebalancing, but also remain invested in a way that diversify their portfolios, either through sectors or through regions. And so Europe fits that picture.
So interesting. Ursula Marchioni, EMEA Head of Investment and Portfolio Solutions at BlackRock, thank you so much for joining us on The Pulse today. Well, switching to some corporate news, the world's largest miner, BHP, has walked away from a fresh takeover bid for Anglo American. For more, let's bring in Bloomberg's deals reporter, Dinesh Nair, who's with me in the Dubai studio. Good to be sitting next to you, Dinesh. Well, it looked as though over the weekend that this deal was going to be back on again. It had gone silent for 12 months or so, over a year. And now you fast forward, BHP have made another potential takeover attempt, but seem to be walking away once more. Walk us through the details. What went down this weekend?
Yeah, it was a pretty busy weekend for us, but the excitement was a bit short-lived. So as we understand, BHP made a renewed approach to Anglo American, an offer which we think was a mix of cash and stock, probably a bit more cleaner than what they offered last year, pretty much the same time. However, Anglo American seems to have rejected that proposal, as we reported, and hence BHP walked away, which means they probably are, as per UK takeover rules, are not going to come back for a few months, actually.
What were the main challenges in getting this deal across the line? Was it just economics, or were there other things to think about as well?
I think there were a few factors last time. I think the key factor was that Anglo American was probably not willing to be sold to BHP, but there were also other political factors coming to it. BHP's offer, when they came in 2024, was contingent on Anglo American doing several things. In a way, BHP was the activist that kind of triggered Anglo American, whose shares were down, trading much below last year, to kind of go out and really restructure their business and do a lot of things. So they've done the cleanup act over the last 1 year. They spun off the platinum business. They tried to sell the coal business. They had an agreement. Unfortunately, they couldn't get through with that with Peabody, but their shares have re-rated considerably.
But Dinesh, the crown jewel is the copper business, right? So what does BHP do from here?
I mean, like every major miner in the industry today, everyone is scrambling for copper assets. The sad reality is that there aren't that many copper assets of size available. The ones who have copper assets don't see any rationale in selling it, so they're hanging on to it with everything possible, as we see in the case of Anglo American. So BHP is probably left with not many other choices to do inorganically, probably why they said in the statement that they believe in organic growth. Having said that, the commitment to the second approach is a bit questionable. Normally, when you are one of the largest miners in the world, you come back for the second time, you go in all in, which they seem to have walked away quite swiftly, probably because they didn't get any engagement. But I think the mining industry will continue to look at opportunities to acquire corporate assets.
Well, exciting weekend in the mining world. Dinesh, thank you so much. That was Bloomberg's Dinesh Nair. Well, coming up, it is finally budget week in the UK, and Chancellor Rachel Reeves is under pressure from CEOs threatening to cut investments. More details next. This is Bloomberg.
Wednesday. Chancellor of the Exchequer, Rachel Reeves, delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg. Context changes everything.
This is The Pulse. I'm Jumana Bersachi in Dubai. UK CEOs are bracing for Chancellor Rachel Reeves to pile further costs on their businesses in this week's budget. Bloomberg has spoken to some who are warning they will stop investing in the country altogether if the government pushes ahead with some of the mooted tax hikes. Anna Andrade from Bloomberg Economics joins me now. Well, Anna, I guess the question is, should we take these CEOs at their word that they'll cut investments in the UK as a consequence of this budget?
Hi, good morning. I think in understanding the context here is important. We're coming out of the year where businesses have been particularly hurt by last year's investment when Rachel Reeves decided to increase taxes on business by more than 20 billion for the private sector. And that obviously had, consequent impacts on the whole economy. We've seen sort of the labor market cooling. We've seen a bit of prices rising because it's very rare that businesses sort of take this hit in taxes fully into their profit margins. So they need to sort of adjust the headcount, adjust prices, and we've seen sort of the repercussions of that happening over the past year in the economy. So another hit to businesses now wouldn't be great, but what I would say is that typically, businesses make business decisions on a longer term horizon, not sort of on a one-year basis, and Rachel Reeves, I would say, and the Labour government in general, haven't really been contributing to sort of policy stability and to sort of stable interest rates. So the fact that they didn't sort of made very resilient fiscal plans 1 year ago has contributed to a lot of uncertainty and a lot of volatility in rates. And if Rachel Reeves now in this budget manages to build plans that are resilient enough to sort of stop these two, factors from dragging on the economy, that will also be beneficial for businesses sort of in the longer term.
Yeah. And Andrade from Bloomberg Economics, thank you so much. And tomorrow we will be giving you a full preview of what Bloomberg Economics are expecting into that UK budget. Well, there's been a lot of talk recently about cracks in the private credit markets following the failures of Tricolor and First Brands. Nevertheless, private credit remains a growing financing method both in Europe and the US. So what are the world's biggest banks doing to ensure that they're still seen as desirable lenders whilst also being selective about only investing in quality companies? Joining us now is Gerry Keefe, Head of Banking for Europe and Americas at HSBC. Good morning to you, Gerry. Good to have you with us. Before we delve into private credit, I just want to zoom out for a little bit and talk about the sheer number of news headlines that we've had this year, and yet a remarkable outperformance for global equities. It actually has been a very strong year for U.S. equities, European equities, Asian equities as well. How has that translated into your business?
Well, one of the things that you see is when you talk about the performance of the equity markets feeding into banking activity, there's almost always an increase in M&A incentive for companies that have market caps that have grown over the course of the year. People who are at the helm of large public companies see those currencies as rising in value and therefore will look to make acquisitions on the back of that. We're certainly seeing an uptick in our M&A financing pipeline. and the credit markets are highly accommodating at this point for most acquisitions that are of high quality, where there's a clear strategic rationale and financeable business.
And in the introduction out to you, I was talking about the huge growth that we've seen in private credit. How is HSBC capitalizing on that? And what edge do you have in what's becoming a very competitive market?
Sure. Well, look, private credit has fundamentally changed the structure of credit markets. And this has happened over the course of the past decade, but with increasing speed over just the last few years. We have since, call it 2015, seen the size of the private credit markets quadruple from roughly, let's call it 450 billion to around 1.7 trillion today. It's still a relatively small proportion of the aggregate credit outstanding, particularly around corporates, but it is increasingly a very relevant source of capital for companies small and large. In fact, the biggest area of growth that we see right now in private credit is around investment-grade companies as opposed to small and mid-sized companies, which is really where the market began.
Yeah, just as you were speaking now, I'm not sure if you saw, but we put up a screen talking about some of the little credit cracks that are beginning to emerge. There was the regional bank exposure about a month ago, Blue Owl scrapping their plans to merge public and private credit funds. Given how much spreads in this space have compressed, are investors getting adequately compensated for the risks that they're underwriting?
Yeah, look, I think one of the biggest risks in private credit is really just around the persistence of returns. I think the kind of high-profile blow-ups that you've highlighted are really the sorts of things at the fundamental credit level that happen when you get into a situation where you have very rapid growth in a market, as we have here, a real sort of competitive situation on the part of lenders to deploy capital. And what that creates is sometimes a rush for deals. And what that means when we look at these situations in hindsight, we see oftentimes at the deal level, you see kind of breakdowns in due diligence, breakdowns in transaction structuring, breakdowns in transaction controls that we would consider to be the sorts of things that as a regulated bank institution we would consider par for the course, but some with more flexibility maybe are free to pursue alternative methods. Now, the fundamental point, though, Jumana, is that just because something is private credit does not make it more risky. This market is populated by, there's a handful to a dozen names who have been in this business for over 20 or 25 years. The business itself has existed since the 90s, and the recent growth has brought in a lot of additional capital and a lot of additional platforms who had not historically been trafficking in the space, and that's where you start to see a little bit more of the pressure to deploy.
Yeah, Gerry, people often forget that 99% of the market in Europe is comprised of SMEs. Would you say it is therefore incumbent on investors to participate more in this space for Europe's ultimate competitiveness in the long run?
So I would agree with that. And I think to think about why private credit became the force that it has, this was initially almost a creation of a regulatory construct that pushed a lot of lending out of banks, that kind of caused banks to need to reconsider lending into small and medium-sized enterprises and lending into longer-dated exposures. HSBC, for its part, we're essentially the largest mid-market bank in the world. We have the client base that private credit funds would like to have access to, and so we're very much active in lending to SMEs, particularly around our innovation banking proposition.
Yeah. Gerry, I'm going to round up asking you a question. There was a major restructuring that was announced at HSBC on the macro side of the business, a streamlining of credit and macro. Can we expect something similar, a restructuring of a similar magnitude in your line as well?
Look, I think all the changes that have happened over the course of the year have been sort of led from the top, with Georges Alhedri trying to cause HSBC to become a simple organization and one that's straightforward and easy for our clients to manage and navigate, and where kind of the personnel and the assets and the funding of the business are very closely aligned to strategy. I think last week's announcement were another example of that. So we'll carry on.
Gerry, thank you so much. A real pleasure to talk to you. Gerry Keefe, Head of Banking for Europe and Americas at HSBC. Well, coming up, we'll be talking to Lithuania's foreign minister about the latest on the U.S. peace plan for Ukraine. That's next. This is Bloomberg. This is The Pulse. I'm Jemana Bersachi in Dubai. Now, stocks extend their Friday rebound as traders increase bets of a rate cut by the Fed next month. Secretary of State Marco Rubio says talks with Keefe for a U.S.-backed peace plan with Russia could extend beyond Trump's deadline of Thursday. A potential breakthrough is pulling oil and European gas lower, with Ukrainian dollar bonds rallying. Plus, BHP backs off. The world's largest miner ditches another attempt at taking over Anglo American, ending efforts to thwart a planned tie-up between its smaller rival and Canada's tech resources. Now let's get straight to the G20, where Bloomberg's chief Africa correspondent Jennifer Zabazaja is in Johannesburg. I guess, this was a G20 summit that was mired in a lot of challenges. A lot of criticism came through from the U.S. president. Many world leaders didn't attend. But as we look back over the weekend, Jennifer, is it being perceived to have been a success?
Jumana, good morning to you. For the most part, I think if we take a look at what we're hearing from a number of leaders who were in fact in attendance, they're touting this G20 by President Ramaphosa in South Africa as quite a success, especially if you consider what you were just mentioning there. Many of the issues that were overshadowing it, most especially probably the U.S. and President Trump boycotting the official meetings. But still, we saw a number of leaders throughout the world congratulating President Ramaphosa, including Ursula von der Leyen, Brazil's Lula da Silva, Kristalina Georgieva. And really the early win for him came with this declaration that was threatened by the U.S. Prior to the summit, which included many of the things that South Africa actually set out for in this G20, which is a focus on bolstering multilateralism, a focus on debt sustainability, and also climate relief. But still, there was quite a bit of silos, I guess is the best way I would call it. If you take a look at this summit, there was a lot of groupings of many nations on issues that are pertaining to them specifically. We saw European leaders surprised by that 28-point plan on Ukraine that the U.S. put out, meeting on Saturday about that. We also saw some BRICS leaders that were meeting about debt relief. And so despite what seems like a consensus on, the importance of multilateralism, there was clearly a showing of still schisms in the multipolar world. And the question is, what does that mean for any of these agreements and the consensus that we did see over the weekend?
Yeah. And yet, despite some of those obstacles, there appears to have been a joint framework announced on critical minerals, I should say. The first time that critical minerals have got such amount of exposure at a G20 summit. What was in that framework?
Right, and Jumana, we should mention this obviously comes off the back of what they put in this declaration as what we've been seeing over the past few months as some unilateral actions taken on critical minerals, which many analysts are taking that as potentially a veiled swipe at China, who was also present. But we did see China agreeing to a new green minerals deal with a number of nations, including Zimbabwe and Myanmar, and also a bit of an agreement about protecting the sovereignty, really, of these nations that are resource strong. So many in the global south, many on the African continent. And if you think about it from various perspectives, which of course investors are going to, China holds a number of rare earth minerals. And if we think about the EV transition, of course, there's industrialization and military tools that are keenly, these minerals are keenly needed. And so it seemed like leaders wanted to focus in on how they can all benefit from the minerals trade, despite some geopolitical tensions that still ensue, despite trade tensions that pursue. And so that really seemed to be the focus. But again, the question is, this declaration is non-binding. And so the impetus is really on these countries taking a lot of these recommendations and implementing some policies that still protect their own national interests, but as they say, aid in the global collective to enhance the mineral trade.
Bloomberg's chief Africa correspondent Jennifer Zavazaja, and thank you for the reporting around the G20 the last few days. Now, Israel says it has killed Hezbollah's military chief in an airstrike on Beirut as an almost year-old ceasefire deal with the Lebanese government wavers. The IDF says the attack killed Hezbollah's chief of general staff, who was the militant group's second in command. Lebanon's health ministry says the strike killed 5 people and injured 28 others. Japan is planning to deploy missiles to a southern military base close to Taiwan. It comes amid tensions between Japan and China over comments Sanae Takaishi made about the island. The deployment is part of a broader military buildup on Japan's southern island chain, reflecting concerns about China's growing military power and the potential for a clash over Taiwan. And President Trump's formal designation of Venezuela's Cartel de los Soles as a foreign terrorist organization will go into effect today, escalating tensions between Washington and Caracas. The U.S. government explicitly accuses the group, whose name translates to Cartel of the Suns, of being led by Venezuelan President Nicolas Maduro. Maduro denies the accusation. It comes amid a massive U.S. military buildup and intensified operations in the Caribbean and Pacific targeting alleged drug trafficking organizations. And moving over to markets now, investor expectations for December Fed rate cuts have been stoked again after comments from the New York Fed president. John Williams says he sees room to lower interest rates again in the near term as the labor market softens.
I view monetary policy as being modestly restrictive, although somewhat less so than before our recent actions. Therefore, I still see room for a further adjustment in the near term to the target range for the federal funds rate to move the stance of policy closer to the range of neutral, thereby maintaining the balance between the achievement of our 2 goals.
New York Fed President John Williams. Well, gold prices have been moving on these Fed lines and are now beginning to edge slightly higher. And you can see over the last couple of days, not doing a whole lot, but this morning moving a little bit in the positive direction. Over the course of the year, of course, gold has been a massive outperformer, up around 50%. Joining us now is John McCluskey, CEO and president of Alamos Gold. Given in the introduction out to you, we just played a little bit of commentary that's been driving the markets from John Williams, suggesting that a rate cut for December perhaps is still on the table. To what extent do you think the fortune of gold is actually underpinned by the Fed rate cutting cycle throughout 2026?
Well, there's been a fairly long relationship between what the Fed does with its rates and the gold price, and as the Fed lowers rates, obviously the opportunity cost of putting your money into gold improves. So that it has always been a key indicator for gold and for investors to move into gold. So I think it's going to be positive. But you know, gold has been trading in a positive direction for quite a long time. I mean, certainly for the last 10 years, we've seen it move from $1,100 an ounce up to $4,000 an ounce. So it's had more to do with, it has had something to do with Fed rates, but it's had to do with many other factors as well.
Yeah, a couple of months ago, we were talking about the great debasement trade that was going on and that investors were looking for alternatives to the USD as safe havens. One of them, of course, was gold. Now, with the dollar stabilizing, do you think that we're going to stop seeing those types of flows, at least sort of the hot money that's going into gold?
You know, I pay less attention to what's going on in the short term, and I take a longer term point of view, and that's what we've done in order to build this company. You know, we've been building it over the last 20 years from virtually nothing into a $20 billion company today, and the view we had on gold when we started, gold was under $300 an ounce, is that that gold was going to ultimately strengthen, and we've seen it trade up and down in a very cyclical fashion as it does over that 20-year period. But right now, I don't think anything that happens in the short term is going to stop this very powerful bull market that we're in right now with gold. I think gold is ultimately going to trade substantially higher than where it is today, and that's really I think that's really the key factor that's drawing investors to look at gold equities right now.
Okay, so you talk about the bullish thesis underpinning gold. What is it exactly? I mean, over the course of the last couple of months, I've been referencing more central bank buying. Is that the catalyst that's going to keep gold moving higher, or do you see it more structural than that, beyond central bank buying?
I think there's more to it, but frankly, for years, the main driver behind the gold price has been central bank buying. And, we've seen gold for a number of years outpace gold equities because the central banks weren't buying shares, they were buying the commodity itself. And so that's a key indicator that that gold itself has led, and the commodities have ultimately followed. So to some extent, you would typically see gold equities trading at much higher multiples to their net asset value in a bull market, but we're not really seeing that up until now. There's just a few cases where gold stocks are trading at premiums to their net asset value. I think that's going to change. But what's driving gold? Certainly central bank buying has been a key factor, but going forward, I think it has to do more with the instability in the world, the de-dollarization that's been going on. It's been led by China, and that's been going on for many years as China has been selling U.S. treasuries and buying gold. But other countries right around the world have been doing the same. And I think it has something to do with the fact that the leadership in the world of the United States right now is not as readily as accepted as it once was. And along with that has been a weakening of the U.S. dollar. I think that's been largely due to the fact that the U.S. has taken on a substantial amount of debt, and that doesn't seem to be going away. It seems to continue to grow. I think all those factors are coming into play.
Yeah. Okay. So gold is up. Spot gold is up more than 50% this year, 55%. Are we likely to get a repeat performance of that in 2026? Do you have a target of where spot gold could get to by the end of next year?
Well, it's easy to project, but that's where mistakes are often made. I think it's very difficult to make specific predictions on where gold will be over specific time frames. But I do see gold very clearly making its way much higher than this $5,000 target that some of the major U.S. banks have been mentioning. But I think that's certainly that's a decent target to pick for 2026. But I think that we're in a multi-year bull market for gold right now, and I think gold will trade right through that $5,000 an ounce level. I think it's on its way much higher than that. The gold miners are doing extremely well. I mean, as a sector, we produce gold for roughly $1,400–1,500 per ounce in terms of all-in sustaining costs, and then everything above that is that's profit. Yeah. So at $4,000 gold, the gold equities are doing extremely well. Imagine how much better they're going to do.
Okay, so as it pertains to your own business, as you look ahead to next year, are you prioritizing growth or return of capital to shareholders in 2026?
Well, we've always tried to maintain both, but primarily, we're not a Barrick or a Newmont. We're not one of these companies that are sort of almost ex-growth. They can grow through acquisition, but trying to grow through their existing assets, it's quite difficult when you're already at that scale. Alamos is a company that's producing just over 500,000 ounces right now, and we're on our way to producing 1 million ounces a year, and we're getting there by growing our existing asset base. We're not getting there through acquisitions. We're taking the mines that we have now, and we're expanding operations at those mines, and that's going to take us effectively from this. We're going to do about 560,000 ounces this year. We're heading to about 1 million ounces, 1.1 million by the end of the decade. That's amazing growth for this sector, and we've been essentially building on that over quite a number of years. We've made a number of acquisitions while the gold price was quite a bit lower, and now we're in effect able to capitalize on that by investing the capital to grow the mines.
Yeah. John McCluskey, CEO and President of Alamos Gold, thank you so much for joining us today on the show. Well, coming up, we'll be talking to Lithuania's foreign minister about the latest on the U.S. peace plan for Ukraine. That's next. This is Bloomberg. This is The Pulse. I'm Joanna Bersecci in Dubai. Well, for more on the wider trends in markets and how investors have been pricing in the AI trade, I'm joined by Bloomberg's Neil Campling. We're seeing a bit of love once again go back into the AI space. We had NVIDIA earnings, and then, of course, our own Bloomberg scoop on Friday suggesting that the U.S. officials are open to the idea of NVIDIA selling those H200 chips to China. What are we seeing in the market?
Yeah, it's certainly interesting times. I think the broader AI market, there's definitely still appetite and interest in a lot of these products. I think that you've seen, obviously, the news around the potential reopening for the Chinese market to NVIDIA is a positive, as is the Alibaba news of the uptake of their new product over the weekend. I suppose one of the things that there's a lot of two-way arguments around the AI trade, clearly, in terms of the rates of adoption are not up for question. One of the biggest questions, though, is whether this massive increase in the hyperscaler capex, which has more than doubled since the beginning of the ChatGPT, is whether we will see, or when we will see, decent returns on that invested capital. And that's one of the questions I think the market has at the moment.
Yeah. Watching out for China tech earnings tomorrow, Alibaba. I want to ask you about ChatGPT's main rival, Qwen. Seems to have drawn 10 million downloads. How is that going to affect the company's valuation?
Yeah, I think it'll be too early for those downloads to affect the valuation today in terms of earnings, but certainly if the message from the earnings call is one of re-accelerating growth, then that could certainly lead to a higher valuation. The same has been happening for the US tech stocks for some time. Whilst many people are looking at US tech and being worried about some of the valuations, I think we also need to remember that much of the growth that has been enjoyed by the tech leaders thanks to AI has meant that really we've not had multiple expansion because it's been growth expansion that these companies have enjoyed. If the Chinese tech heavyweights such as Alibaba and Tencent can enjoy similar types of growth characteristics, then that's got to be a positive for AI adoption and the AI thematic.
Bloomberg's Neil Campling, thank you so much for joining us on the show today. Well, the deputy head of the Office of Ukraine's president has told Bloomberg it was, quote, a little useless talking about peace when they face daily missile bombardments. In recent months, Lithuania has accused Russia of violating its airspace and sabotaging Poland's railway. Let's bring in Oliver Crook, our chief European correspondent, who's in Brussels now with a guest.
That's right, Jemana. I mean, I think everybody here in Brussels and really the United States and certainly in Kyiv are trying to digest what the 28-point plan looks like now after those 24 hours of negotiations we saw in Geneva between the Ukrainian and the American delegations. And I'm very pleased right now to be joined by the Lithuanian Foreign Minister, Minister Budrys. Thank you so much for taking the time, speaking to us at the sideline of this meeting that's supposed to focus on trade. Yeah. I'd like to begin first with your reaction to this 28-point plan and what Europe's strategy is to get their voice heard in this conversation.
Of course, that's the first priority for Europe, to get at the table with our interests being protected during the conversations and the negotiations. And the fact that Europe is not there, it is a problem. And what we have to do, we have to get the ticket to the table, number one. And number two, also to get some leverage. And those two things that provides the Europe the access to negotiations are frozen assets, number one, and number two, that is EU accession for Ukraine. We have to instrumentalize those elements, and as soon as it is possible, because it is needed right now. Frozen assets, we have to give it as a loan to EU first, and then a circulation loan to Ukraine, because that would provide something credible.
But there is a sort of concern because those Russian assets were explicitly referenced in the 28-point plan, and the United States has different kind of ambitions for what to do with it. So are those assets now off the table, or on the contrary, is now the moment that Europe needs to act?
After last week, the very context in which we assess the options has changed. So now there is more urgency in the very decisions. So now it's the time to make a decision that we are proceeding with it. We are still waiting for the legal proposal from European Commission, and let's do it. Let's act. Otherwise, it will be a lost opportunity for Europe to play the relevant role in it. And the very fact that they are mentioned in those points, it shows that it is important, and it is in our hands, in Europe's hands.
So there's a question of getting to the table. Once Europe is at the table, what are the red lines for Europeans from what you saw from that 28 proposal? What are non-starters?
We need a working, credible security structure that wouldn't be based on some promises not to invade anymore. We have seen it in 1994 in Budapest, and 20 years after Ukraine first time was invaded by Russia. So we cannot build our security on the hope that Russia will keep the promises. They never did, and they do not respect the international law. Why they should, in the upcoming 5, 10 or 20 years? They won't. So that's why we need the credible working deterrence system, and that it is building the European security with Ukraine. And it's for us to decide how we will do it. It's not for the others, and especially not for Russia.
The other thing that I'd like to discuss is also we have not really seen a proposal from the European side. We get these proposals that we don't know exactly how this 28-point plan was put together. There's lots of questions about it, but I don't see a comprehensive, clear proposal for what the Europeans would put together and put to the table. What would that proposal include, and what do those security guarantees look like? Are we talking about an Article 5 light? What are we talking about specifically?
It doesn't mean that Europe doesn't have what to say. Of course, we start to talk about the fundamentals, but this is the very beginning and the very guarantee for the peace to last. Talk about fundamentals: territorial integrity, sovereignty of Ukraine, independence of Ukraine, and also accountability for all the crimes that were committed. If we are not getting this, if we are really talking about amnesty to everything that was done in Ukraine, for the children being abducted, for the civilians being also kidnapped, so we cannot talk about anything that would last. And those elements that Europe already agreed on, as Lithuania is part of the coalition of the willing, we will be part of the securing and supporting Ukrainian forces after the ceasefire. So there are other elements also. EU membership, that's one of the also elements of the security guarantee.
One of the other issues you need to tackle today, you'll be meeting with Jameson Greer, Howard Lutnick from the United States. What would the Europeans like to get out of those trade negotiations? Is that what that would be considered a victory? And added to that, how much leverage does Europe has, given how dependent they are right now on the United States buy-in for Ukraine? Do they have any leverage to throw around on trade?
Of course we have. There are so many common challenges that we all face, and that is China, first of all. Overproduction, unfair trade practices, and all of these. So this is the common challenge for us. And during my visit to Washington, we were talking about the economic security that unites us, that we shouldn't work against each other, be it steel and aluminum. That's not Europe that is causing the problems for the United States. That's China that does. And there are many, many other areas. So I'm looking forward for the discussion on our positive agenda where we can and must cooperate on it. And we should take to we have to finish with everything that we talked and agreed upon in August negotiations and proceed with the broad agenda.
And on the question of China, Lithuania has been one of the more outspoken member states from the European Union, talking about some of those issues that were sort of pushed away by many other member states now, I think, are being more openly acknowledged. Do you think that there could be a sort of more concrete framework that the Europeans and the United States could work with together to get the U.S. on board to deal with China?
Now, first of all, we have to reduce our vulnerabilities. That is the lesson number one and the largest one from Lithuania. If there is vulnerability and knowing that China has the intent to use it for political purposes, they will do it. Yeah. So no one should be surprised that they instrumentalize the export controls of the rare earth minerals. That's what they promised to do, and that's what they did for Lithuania in other areas. Yeah. So for us, reduce the vulnerability, diversify the trade, build a stronger transatlantic agenda for economic security and be very strict and straightforward with China what concerns their investment policies and trade policies in Europe. We cannot be the area for the dumped imports and for the subsidized materials destroying our industries.
Well, Minister, thank you so much for your time here, speaking up the sidelines of this meeting with the U.S. delegation that will begin in just a couple hours' time. Some thoughts there on trade with China, but also the key movement here for the Europeans. They must move now on the frozen assets. That's the message.
Such a timely interview, Bloomberg's Oliver Crook in Brussels. Thank you so much. And later, U.S. Commerce Secretary Howard Lutnick joins us live from Brussels, where U.S. and EU teams are hammering out the details around their own trade deal. You can catch that at 11:45 a.m. London time. But up next, Bloomberg Brief. This is Bloomberg.